Over the next 6 months, we're looking at gold prices to rally towards $2,100 per ounce. The US credit downgrade, plus a very rare technical warning signal. And I also want to talk about how the Federal Reserve's perceived pivot is already affecting the price of gold. And lastly, we're going to talk about housing affordability. More accurately, I guess, we're going to talk about the lack of housing affordability. You guys know that this is an incredibly pivotal time in the world. That's why we always ask you to help us get our message in front of the eyes of people who will benefit from it, people who need to hear this message, people like us. And anything you could possibly do would be greatly appreciated, but we ask you to click like on this video.
At Peter Leeds, we're all about getting you profits quickly and easily. Please subscribe for more premium investor enlightenment.
Moody's lowered its outlook on the U.S. credit rating to negative from stable, citing large fiscal deficits and a decline in debt affordability. Well, yeah, I saw this stuff coming. I told you guys about it. You knew it well before Moody's ever did. And now they're finally coming along and seeing the problems that I explained would be a problem until they get fixed. The move follows a rating downgrade of a sovereign by another ratings agency, Fitch, this year, which came after months of political brinkmanship around the U.S. debt ceiling. Federal spending and political polarization have been a rising concern for investors, contributing to a sell-off that took U.S. government bond prices to their lowest levels in 16 years. Just for anybody who thinks that bonds are a safe investment, there you go. A lot of people got wiped out with their bond investments over the last number of quarters.
Your teachings are the best that I've ever come across anywhere. I learned so much more about investing after joining the Peter Leeds Academy.
A Moody's downgrade could exacerbate fiscal concerns, but investors have said they are skeptical it would have a material impact on the U.S. bond market, seen as a safe haven because of its depth and liquidity. Quincy Crosby, chief global strategist at LPL Financial, said, "Our $33.6 trillion debt is unsustainable and poses a danger to our national security and economy. We will fight to get our finances in order." Okay, Quincy, take it easy. Listen, man, it's going to take a lot more than fighting. When the CPI report came out, that's the inflation on consumer goods, when it came out flat compared to the month before and some other indicators showing that inflation is slowing down, that got the market exploding higher, people cheering the market and assuming that the Federal Reserve is done with their interest rate increases and potentially next year will lower them 3 or 4 times in the year. Let us help you navigate the slow motion economic train wreck that we're all going through right now. Please click like on the video, make a comment, and hopefully you'll subscribe to the channel to get more videos just like this one. That's why stocks went up so much the other day. And also, that's why gold prices spiked up pretty well. They've, of course, given back some of that gain temporarily, in my opinion, but it spiked higher nonetheless. And when the interest rates start coming down, start being lowered, you're going to see even more of a wind in the sails of gold prices. Gold prices gained as the dollar and treasury yields retreated after softer than expected U.S. consumer inflation data, which fueled more bets that the Federal Reserve may be done hiking interest rates. CPI data came in significantly weaker than expected, which is quite supportive for precious metals. We're expecting a significant deterioration in the data over the course of the fourth quarter, which has weakened the dollar and support gold, said Daniel Gali, commodity strategist at TD Securities. Over the next 6 months, we're looking at gold prices to rally towards $2,100 per ounce. As promised, let's talk a little bit about home price affordability. And just so you know, I do believe, me personally, that home prices are going to be declining pretty significantly in the United States. It hasn't begun yet, but we're going to get into it more deeply in an upcoming video. But I don't have a lot of hope for real estate prices to keep climbing like they have been. The housing market in the United States is the least affordable it has been since 1984. It now takes nearly 41% of the median household's monthly income to cover the principal and interest payments on the median priced home, new data shows. This comes as a painful combination of high mortgage rates, soaring home prices, and low inventory is pushing the American dream further from reach for many prospective home buyers. And if you like that, we're ad-free and sponsorship-free. Consider joining the Peter Leeds Army, link below. Now this one is about the rare technical indicator. This is from CNBC. A rare technical signal was flashed recently, and it's not a good one. The NASDAQ 100 last week closed less than 5% below a 52-week high, while the Russell 2000 ended less than 5% above a 52-week low. They say this signal is extremely rare, and it normally is followed by steep losses in the stock market. 8 weeks following the signal flashing, the NASDAQ 100 and Russell 2000 have lost 4.1% and 6.7% respectively on a median basis. And that's what the problem is, and this is what you're hearing. The stock market's doing well, but a lot of that gain is all coming from a small selection of very well-performing stocks. It's not as though it's a broad-based rally. It's a very specifically based rally, and that's the point of this article. That's the point of how it's set up now.
I was a financial advisor for 5 years from 1999 to 2004 and never heard the type of info that Peter gives us, the type of indicators he looks at which are non-traditional. He knows his stuff.
Which usually ends up with a 4.1% or 6.7% on average loss. This signal was flashed amid concern that this year's market gains come from only a few stocks. Nvidia and Meta platforms account for the lion's share of the 2023 rally. The S&P 500 is up nearly 15% year to date, and the Nasdaq 100 has surged 41%. Without other parts of the market participating in this rally, this year's gains could be in trouble if the leaders start to wobble. And if you haven't done it yet, please remember to click like on this video. It really helps us out a lot. This one's from CNBC also, and I brought it out even though we talked about a little bit of this already earlier, because I want to say a few things or comment on a few things from this article. The consumer price index was flat in October from the previous month, but it increased 3.2% from a year ago. Both were below Wall Street estimates. Excluding volatile food and energy prices, core CPI rose 0.2% and 4% against the forecasts of 0.3% and 4.1%. The annual rate was the smallest increase since September 2021. One more line I pulled out of this article I really want you to hear. Following the report, traders took any potential Fed rate hikes off the table almost completely. Despite the deceleration, the Fed will likely continue to speak hawkishly and will keep warning investors not to be complacent about the Fed's resolve to get inflation down to the long-run 2% target, said Jeffrey Roach, chief economist at LPL Financial. Even if the Fed is done hiking, there's more uncertainty over how long it will keep the benchmark rates at the highest level in some 22 years. EBS sees a raft of Fed rate cuts next year on the back of a U.S. recession. I'm not even going to get into this article because it'd be insulting. This is what I've been telling you about. As soon as we get into a recession, they're going to panic and start dropping rates really quickly. Moody's warning on the massive U.S. debt burden has turned into a non-event. People are just walking around like they've been hypnotized. It doesn't mean that you have to be one of them. It's amazing to have such a massive and such a monumental problem right in front of our eyes. We identify it, we talk about it, and they just shrug it off. I'm sorry, I didn't realize that we don't need to worry about this. And don't forget that the Peter Leeds sale is still active. You can save $50 on a Peter Leeds newsletter subscription, $60 on the Peter Leeds trading chart course, or $100 rebate on the Peter Leeds Academy.
Your teachings are the best that I've ever come across anywhere. I learned so much more about investing after joining the Peter Leeds Academy.
At Peter Leeds, we're all about getting you profits quickly and easily. Please subscribe for more premium investor enlightenment.